Coming up on MSI Wealth Chronicles.
Improving your credit will 100% definitely help you achieve your financial New Year resolution goal.
On personal experience, if you're not intentional, if you're not writing it down, if you're not revisiting those goals, then you're not measuring it, you're not tracking it, and it's out of sight, out of mind.
Yeah. The toughest part is getting started. I would say the very beginning is the toughest part. Improving your scores, and then paying off this debt, whatever, accomplishing this goal. But then they'll just start snowballing. And it just gets easier and easier and easier. So stick with it.
It's better be prepared for an opportunity than have an opportunity and not be prepared.
Yeah.
So yes, you have to stay ready, so you don't have to get ready.
There you go. There you go.
That's the one.
That's one of the things that you can do is you can call your credit card companies. You can ask them to increase your spending limit. And if they say yes, boom, automatically your scores are going to go up. Improving your credit score will improve your DTI, which will make you less riskier to the bank, which will give you a better interest rate. More than money, it's about empowerment. Welcome to MSI Wealth Chronicles. My name is Ricardo Mendiola, and this is the one and only
Vanica Anguiano.
Yes, it is. And first of all, let's wish everybody a what?
A Happy New Year.
Yes.
Happy New Year, everyone.
Yes, Happy New Year's. And today we want to talk about New Year goals, New Year's resolutions. And we're going to dive right in. And what we want to talk about is how a lot of your, the two most common New Year's resolutions, right, are the categories, you could say, are financial and health. And a lot of people don't realize that your financial goals, they're typically all attached to your credit. In other words, your credit, improving your credit will 100% definitely help you achieve your financial New Year resolution goal. So let's dive in with that right away. So what would you say is one of the most common New Year resolution goals that our clients always preach to us, always tell us about?
One of the most common goals that they have is they always want to purchase a home.
Exactly.
They always want to purchase. That's like the top. I always tell everyone it's probably like 99% of the goals that they have, especially coming into a new year.
And could you give us some examples of how having good credit, I think everybody will know, but still doesn't hurt to go over it, how having good credit will actually help you achieve that New Year goal of buying a house?
Well, having good credit, it helps out in so many areas when it comes down to buying a home. For number one, interest rates. The higher the credit scores, the lower the interest rates. That means thousands of dollars that they can save on a term of a loan. I know that not many people always break it down because they think of just the interest rate, but they don't really break it down to the dollars. Yeah. And it really does play a huge role in that area. Yeah, because
get this. So I think everybody knows that I do real estate as well. And it's crazy. So we all got, well, everybody did. Everybody got to see the COVID days, right? And interest rates dropped to they actually dropped to like 1 point something. We weren't able to refinance any of our homes into a 1 point something, but we were able to refinance some of our homes into like the low twos. But it's crazy seeing, like for example, a $400,000 house financed at 2%, right? We got to see that. I got to see that, especially being in real estate. And then now I get to see my clients buying that exact same price amount with a 7% interest rate. And it's crazy how much their payment goes up. And it explains also why the market slowed down. So 2024, the housing market did slow down a little bit. And, one of the number one reasons we all know it's because interest rates. Interest rates are, in 2024, they were, the peak of 2024 for interest rates, for mortgage interest rates, were the sevens. They actually got to the sevens. But the feds have dropped the interest rates 3 times already. They dropped them down in hold on. Okay, let me go backwards. They dropped it down in December by 1/4 point. They dropped it in November by 1/4 point. And then they dropped it in September by 1/2 point. So they are lower. Right now, mortgage interest rates are in the 6s. But still, like you were saying, that is still super duper high. If you buy a $300,000 house and you put the minimum down payment, and with today's interest rates of being in the 6s, I mean, your payment's still going to be in the high 2s, $2,500, $2,600, $2,700. But back in the COVID days, if you would have got a 2% interest rate, your payment would be like $1,800, $1,900.
Huge difference.
Yes, you're exactly right. If your score is below qualification, well, number one, improving your credit score is going to help you be able to get approved. But then number two, even if your score is above qualification, get as high as you can, because the higher that you get, the better interest rate that you will get. And here's another one that a lot of people don't realize, where your credit affects you with buying a house, is the type of loan. So I don't know if you guys know, you know, what are the two most common loans for a house? I know you know.
The FHA and conventional.
Good job. Yep. But what a lot of people don't know is FHA is the more lenient of the two. So FHA will give a loan to people with a lower credit score. And conventional is a little bit more picky, you could say. They're a little bit more strict about who they accept, who they give a loan out to. But which is a better loan of the two? In my opinion, and some people might say otherwise, it's 100% conventional. And one of the biggest benefits to getting a conventional loan versus a FHA loan, you probably know too, is what? And if you don't, it's okay.
It's the PMI.
Yeah. Good job. And I'm putting you on the spot, but good job.
I've done my homework. Thank you. No, it's life experiences.
Yeah. But yeah, the private mortgage insurance. So because FHA is so much more lenient, they're taking on more risky clients. So guess what they do with those risky clients? They tell them, hey, because they're not literally telling them this, but you could say they are saying this. Because they're dealing with someone more risky, they're making them get insurance on the loan, you could say. Not insurance on the house. You already have to have insurance on your house in case it burns down or you have, a flood or whatever. But they're making you get insurance on the loan. And with the FHA loan, it doesn't go away. You have to pay that insurance for the entire 30 years if you finance it for 30 years. But I think we all know this, and if we don't, it's okay. With the conventional loan, that you still have to pay that private mortgage insurance, but it goes away after what?
Is it 20%?
Good job. Yep.
Equity, right?
After you have 20% equity, it goes away. Yep, it goes away. So that's another big, benefit to having a better credit score is don't just try to get in and buy a house. Try to get in and get a conventional loan. And maybe you're in a hurry to buy a house and you can't wait till your scores to improve. Okay, cool, no problem. Get your home, get an FHA loan if that's all they give you, but then make it a goal to refinance into a conventional loan. So now you'll have two goals: get the home, even if it's with the FHA loan, and then after you get the FHA loan, after your scores improve, try to refinance into a conventional loan. So, yep. Okay. And you were mentioning another one. We were talking a little bit before the podcast about another benefit in the area of buying a house. What's another area where your credit impacts you?
On your debt to income ratio.
Yep. That's another one. Do you want to explain that one, or did you want me to explain it? Or?
Well, I mean, when it comes down to the debt to income ratio, it comes down to as far as like how much of a home that they're being able to get approved for. Yep. So in most cases, when it comes down to your credit score, the interest rate that you're paying on your credit cards, that also impacts your monthly payment.
Yep.
Right. So that gets taken into account into their debt to income ratio. Yep. So in most cases, a lot of our clients, what they tend to do, especially everyone's always saving money. Their goal is obviously they're saving money because they have to go and buy a house. So let's just say a client has a credit card and they're looking to pay that off because that's the goal. That ideally, that's what they're thinking. I'm going to pay off this credit card or pay as much as I can towards this credit card so that my credit scores can increase. But essentially, they also have, let's just say, a car loan. Most people have a car loan. They have an installment loan. And let's say they have $5,000 to put towards some of their debt to pay down. Yeah. And their car payment, let's just say it's $500 a month. And let's say they owe $10,000 on the car. Yeah. And then they have $10,000 debt on a credit card. Well, they're going to go and put those $5,000. In most cases, most of our clients and consumers tend to say, I'm going to go pay down the car. Yeah. And so then they want to bring down the value, the balance in the card to $5,000. But what they don't stop to think about is that monthly payment still stays the same at $500 a month. As opposed to on their credit card, if you pay that $5,000 towards that $10,000 debt that you have, it's going to basically minimize the monthly payment because because the interest that's rolling over, it becomes less because the balance is less. And so therefore they get to get approved for more of that. Is that correct?
Yep. Yeah. No, good job. You know, and I'll piggyback on that. So yeah, debt to income ratio, DTI, that's another thing that gets looked at whenever you're buying a house. And what a lot of people don't know is, so for example, it's all a risk factor. So your credit determines how much of a risk you are to the lender. Your DTI does too. And here's kind of what it means. They look at your debt and they look at your income. So for example, let's say someone makes $10,000 a month. Let's just use that for easy math. If someone makes $10,000 a month, and whenever the bank looks at all your debt, here's what they look at. They look at the debt that's on your credit report. So they look at, like you were saying earlier, they look at all the minimum payments on your credit cards. They look at your payments on your vehicle loans. Let's say you have 2 vehicle loans. They look at that. And then they also add your payment for your new home. Let's say your new home payment's going to be $3,000. All right, so let's use $3,000. And let's say you have 2 cars, 2 vehicle loans for $500 each. So now you're at $4,000. And then let's say you have a bunch of credit cards, and when you look at all the minimum payments on all those credit cards, they total up to be $1,000. So that's $1,000 plus your new mortgage payment of $3,000 plus your car payments of $1,000. That's $5,000. So they compare the $5,000 worth of debt to your $10,000 of income, and that's a debt to income ratio of what? 50%. So in other words, you're using 50% of your income. The lower you get, the lower that number becomes, the less riskier you become to that lender, and the better interest rate you get. So that's kind of the picture that we wanted to paint is improving your credit score will improve your DTI, which will make you less riskier to the bank, which will give you a better interest rate. So yeah, that's another area. And then as it pertains to buying a home. And then another area that a lot of people don't know about, and still to this day, even whenever we have new hires, a lot of our new hires don't know about this, and that's insurance. So whenever the bank is calculating your debt to income ratio, they also put in the DTI formula, they add your insurance payment. And what a lot of people don't know is that your home insurance payment is calculated based also on your credit score. Yeah, they look at a bunch of other stuff, right? Like if you've made a bunch of claims, any kind of claims. So, but they also look at your credit score. A lot of people don't know that. Any kind of insurance, they are going to look at your credit score, and depending on where your credit score is at, it will determine where your premium is going to be. So those are the top 3 that come to my head whenever, if anybody out there is wanting to buy a house, improving your credit score is going to play a big factor in you being able to get approved, what kind of interest rate you'll get on that home. It's going to improve your DTI if you improve your credit score, and then you're going to get a better home insurance premium by improving your credit score, which also circles back to your DTI. So can you think of any other benefits as far as for the people that are wanting to buy a house, how improving your credit score plays a huge role in being able to achieve that goal?
Not as far as on credit purposes, but as far as giving you something, to definitely work. Say, I'm working hard for this, then I would say that's it. I think you got it all.
We got it all.
We got it all. Okay.
But another one
I get a round of applause for mine. Okay, right? What did I say? 3 for 3?
Yeah. But another one that we hear about a lot is saving money. And a lot of people don't realize, right, when they want to save money, they want to have an emergency fund or whatever it might be. And a lot of people don't realize your credit will help you save money. Like one of the things that you could do, and we'll just keep going back and forth, is look at the interest rate that you have on everything that you're financing right now. If you bought a vehicle in 2024, 2023, it's probably pretty high. And with the feds dropping the interest rates 3 times, I guarantee you, if you improve your credit score, okay, you'll become less riskier when you go back to the bank to refinance that vehicle. So you'll get a better interest rate by refinancing the vehicle because you improved your credit score. So saving money, if someone wants to save money, that's one of the ways that you can save money. A lot of people are just thinking about, maybe budgeting better and maybe not spending, as much as they're spending or maybe making more money. But a lot of people fail to look at saving money as it pertains to what I was just talking about, refinancing everything that you have right now, getting a lower payment, and there you go. The difference between the two payments, save that money. It'll help you. It'll help expedite the process of saving money.
And it's like a snowball effect when it comes down to saving money, because as you learn the ways of how to save money, in this case, doing a refinance, the money that you save, you can also put it towards maybe other debt that one has, because some individuals carry balances on their credit cards and that debt continues to accrue interest. And so the higher the balance also impacts the credit score. So you lower that balance. It helps increase the credit scores because now you're decreasing the debt. And so taking some of that money that's saved gets to kind of, everything just works hand in hand.
And even homes. I tell all my clients that bought a home in 2024 and 2023, I tell them, because I figured, everybody figures, it's not like I'm just guessing what's going to happen, but I figured that we were around the peak of interest rates. I didn't think they were going to go higher than what they got to in the 7s. So I told everybody that bought a house from me as a realtor in 2024 and 2023, hey, make sure, keep your credit ready, because I think this is the peak of how high interest rates are going to get. They're going to get lower more than likely in 2025, and you want to be ready for the opportunity to refinance. It would be devastating to buy a house in 2024. You got a 7% interest rate. Rates drop to the, let's say, high 5s in 2025, being realistic. And then you go to try to refinance to take advantage of that, to get your mortgage payment, lower by $1,000. And then they say no. Why? Because your credit score is too low or whatever it might be. So that's what I tell all my clients that purchase a house in 2024, 2023, have your credit ready, because the opportunity will come unless something drastic happens, another COVID or something. Unless something drastic happens, rates should continue to decrease, and anybody that bought a home in 2024 and 23 will have the opportunity to be able to refinance if they're able to seize that opportunity with their credit score. But I know on saving money, I mean, we could probably go on and on. So refinancing everything is a way that it could help you save money. We talked about that. What are some other areas where people could save money by improving their credit score? Car insurance is another one. A lot of people fail to do that. They get whatever car insurance company they have right now is who they got when they bought their car 3 years ago. They never shopped it. Or
some since they started driving and had insurance on their car.
Because it's a hassle. It's a hassle. But I'm telling you, sometimes you could find, like, let's say you don't improve your credit score. Sometimes you could find a better provider that offers you a better insurance premium. So just that simple reason, right? Just always shop to save money. But if you improve your credit score now, today, whenever this year, definitely one of the things that you want to do, other than just refinancing everything to a cheaper interest rate, is go ahead and shop all your insurances. If insurance on your vehicle, insurance on your home, insurance on anything, shop it, because more than likely you will be able to find cheaper. Why? Solely because of you improving your credit scores. Why? Because we said it earlier, insurance providers look at your credit score to determine how much of a risk you are, and that determines your premium. So yes, if you improve your credit scores, definitely 100% shop your insurance on anything that you have, whatever it might be. So that's another one. Anything else?
I would say another area, because there are some providers like utility providers that look at your credit score, is also shop what it is that your rates that you're paying for your electricity and things of that nature. Because I've noticed that the higher my credit scores have gotten when it comes to the plans that I've had with electricity, they drop. And so what I've paid overall on a monthly basis, you save a substantial amount of money. But it's just finding those areas where you can save money, and that overall is going to help you achieve your credit goals, because you're going to be able to use what you save to put towards rebuilding your credit.
And deposits, you're talking about that. Deposits, they 100% look at your credit. If you don't have great credit, they'll 100% give you a higher deposit. And that money, if you did have a better credit score, could have been used for, paying off some other type of debt that you might have to snowball, like you were mentioning earlier.
Yeah, it all adds up, but it does take time. It's those things, like they say, the good things don't come easy. It takes a little hard work and a little sacrifice. And the thing about credit is just short-term sacrifices that you have to make when you have a plan.
Yeah.
And especially when you have professionals that have gone through this process, that have experienced it, and educate clients, consumers at all times.
Yeah.
I think we have a great way of being able to teach. And this is an opportunity to sit down, to kind of learn, put pen to paper, and really know what it is that you're paying.
Yeah.
I think a lot of individuals tend to get into credit challenges because you just tend to kind of just go with it, just make purchases and not really know, and just go off of what you're told, but really, really learn it, because it's going to help you overall for the rest of your life. And it's also going to help you educate your loved ones, your kids. It's a beautiful thing when you're able to regain control of your finances and achieve the goal that's set for that year. But it's an even greater benefit, and it's so beautiful when you get to learn it, to teach your loved ones, and to see them being able to save money through their life purchases.
Yeah, so true. Good stuff. Here's another one as it pertains to saving money as well, is security clearance on jobs. A lot of people want to save money. Well, one of the ways that you can save more money is by making more money.
Of course.
And how do you make more money? I don't know. You switch careers, or you get another job, or whatever it might be, right? But that's another area that a lot of people don't think about. A lot of career opportunities look at your credit. Government jobs, they look at your credit. Even a loan officer. My wife's a loan officer, and they look at your credit. Typically, if you're dealing with finances, they're going to look at your credit. They call it security clearance. So if you're wanting to possibly make more money by switching career paths, and you're thinking about going into the financial industry, more than likely they're going to look at your credit. So improving your credit scores will definitely help you pass that security clearance. And yeah, I mean that's a big one. I mean, I've seen people get fired because they work in the financial industry, and they messed up their credit while they were in the financial industry, and then they find out about it and they get fired. So definitely security clearance, fixing your credit so you could, whatever, pass security clearance will definitely help you save up money as well.
I feel that a lot of times, and I would say it's speaking to our clients, a lot of times when they've gone through the credit challenges, sometimes they seem that there's just no way out of it at all whatsoever. But kind of like related to health, there is a way. There is a way. There is a way out, just as it is with your credit. But it's just actually being intentional about learning and doing the work, the legwork that needs to be done. But it pays off. And I will definitely have to say, through our clients' stories, to where their success stories, but also just one's personal success story. I've been a part of this journey with this company, with MSI for almost 16 years, and in that time, getting to learn, and as far as being taught, through your journey and everything, is I've gotten to sit in the seat of being able to refinance a home and being able to save, and being for myself an individual that helps out her family. Your parents get older. Not everyone's family has money just set aside and just saying, hey, I can support myself now that they're disabled or retired, and their money doesn't take them all the way. So not only for one's financial goals, but also being able to provide for your family in different ways. And it's amazing. It's a beautiful thing to be able to show up for your family and provide, but being able to refinance. So all to say is that I refinanced my home, and I got to save hundreds of dollars, on a monthly basis.
What interest rate do you have?
From when I got to refinance, it was like a 4.25, I think.
Okay.
Yeah. But I mean, that in itself was a huge amount of savings.
For sure.
A huge amount of savings, and then being able to pay the house off in a lesser time. So there's a lot of benefits, a lot of options that one has. I feel overall it's like a big confidence booster, and being able to know when your credit's right.
Exactly. Yep. Awesome. What is another New Year's resolution goal that you hear about a lot?
Let's see here. Buying a new car.
I was about to say that one. Yep.
Buying a new car.
And that one's pretty simple, right? As far as how does credit pertain to helping you be able to buy a car? Well, they look at your credit. They look at your credit. And I mean, kind of like we were talking about earlier, more than ever, credit's important right now because of these high interest rates. I think I talked to someone, and this is pretty low. I think it was Jesse. He just bought a new vehicle. I think he got like a 5%. 5% right now for a vehicle is awesome. So he got that 5% because he has great credit. And then also I think they were doing a promotion or something like that. So if he didn't have great credit, there's no way that he probably would have gotten that 5%. Because if you don't know, his vehicle's used, it's fairly it's fairly new, so it doesn't have a lot of miles. I forgot what year he said it is, but anyways, whenever you buy a new vehicle, they give you a better interest rate than used vehicles. So for him to get a 5% or something like that on a used vehicle, yeah, that's awesome. Yeah, and like I said, you could give the credit to having good credit. So yes, if you want to buy a vehicle, definitely improving your credit scores will help you be able to purchase that vehicle, and not only just get approved, but be able to get a good interest rate so your payment could be lower.
But I would say not only a good interest rate, but also negotiating power. Because when it comes to buying a car, you have to really have some negotiating skills, right? Yeah. And I would definitely have to say that when knowing where your credit's at, you increase your buying power and your negotiating power. Because when you go to dealerships, a lot of our clients, seeing the credit reports, all the inquiries that they have, and yes, we do understand there's buffer periods, but being able to know that you can go to like a credit union and being able to get pre-approved and go in there knowing what you're able to kind of shop around with. Yeah. And when you don't have a good credit score, you can go in wanting one car, but you're going to walk out with what they can put you in. Yeah. And so you don't want to have to go through that. You want to make sure you have that financial control and get your credit right and get what you want.
You don't want to do what I did back in 2003. My credit was so bad, I had to go to one of those touch or no places. And that's like 100% interest rate. You go in there and they tell you, okay, you're going to pay $300 every 2 weeks or whatever, or $100 every week. When you do the math, when it all ends, you paid, 3 times the amount of what that car was worth. Yeah. All why? Because I had bad credit. But and then also, before we move on to another New Year goal, vehicles, I started seeing promotions, and you'll see them. Even last year, whenever interest rates were really high, you would see them, but not often. But I saw one the other day, probably because I drive a Tesla, but Tesla was doing 0% interest. Yeah, they were doing 0% interest. So think about that. You see 0% interest. You're in the process of buying a car. You're wanting to buy a car. You're thinking about buying a car, but the only thing holding you back was that it's so expensive to finance a vehicle right now. So you're kind of holding back. But let's say you see that advertising, 0%, right? Well, one of the qualifications is going to be what? Good credit. Yeah. So you definitely want to be ready, to be able to seize any opportunity that comes along the way. And like when I saw that, I was like, wow, that's crazy, 0%. So I guess they're just trying to move their inventory or something. But 0% right now, that's phenomenal. So, yep. And let me say another thing as it pertains to homes. So that was the first topic that we talked about. A lot of builders are being very smart right now. And they know that the pain point for consumers right now is it's expensive to buy a house. Your payment's really, really high. So what a lot of builders are doing right now is they're buying down your interest rate. So if you buy a house right now that's pre-existing, and you go with your local bank, you're going to get right now 6%, somewhere around there. If you put the least amount down, you'll probably get somewhere in the 6s, mid 6s, low 6s if you're lucky. But a lot of builders are buying down your interest rate. 3.99. I've seen some builders, they'll buy your interest rate down to 3.99. So you could buy a house right now and get a 3.99. You could get I've seen them go up to 4.99. I've seen them 5.1, but all that 3.9, 4.9, 5.1, whatever your builder that you're thinking about going with might buy down your interest rate to. It's, even if it's 5.1 is better than what you'll get right now, 6 point something, makes a huge difference on your payment. So once again, you have to be ready. You literally have to be ready. And it's crazy how it works. Typically, opportunity comes whenever you're not ready at times. Yeah. So you need to be ready because it'll come whenever you're not ready. So you need to stay ready. Yeah.
What is that quote?
Dion or something?
Well, it says that it's better be prepared for an opportunity than have an opportunity not be prepared.
Yeah.
So yes, you have to stay ready, so you don't have to get ready.
There you go.
That's the one.
That's it. Yeah.
I will say this. Okay, so with credit being a goal for the new year, there's also, believe it or not, some of our clients. I bet you don't remember this one. What do you think is another reason why they want to repair their their credit and get it higher this time of year?
As it pertains to like goals, like New Year's goals? I mean, house, saving money.
There's
buying a car. Let me see my notes.
You have a hint. Look at your hand.
Getting married?
Yes, getting married. A lot of individuals, with marriage, if their goal is to take their relationship to the next step, they want to get married. Mm-hmm. So remember, grade school, first comes love, then comes marriage. Then, so they're planning their family. What do they want to do? They want to go into a new home. So as they're planning their marriage, they're also planning their overall finances, and they want to take advantage of their credit, but they want to buy a home. So yes, it all it's like it's a snowball effect. Yeah. It's one thing leads to another. Yeah. But a lot of the clients, there's some clients that want to improve their overall credit to being able to take their life into the next step, the next journey of their life, and that's marriage.
And credit would definitely help out your marriage. I mean, what's the number one? Probably a reason for divorce, and money, stress. Mm-hmm. So you having better credit will definitely help that area out. I remember before we got married, we took like a premarital class, and I told you about it. And that's one of the cool things that they made us do is they literally made us put everything in writing as far as what debt we had, what our credit score was, what debt we had, because they made us get that out in the open now versus figuring out or finding out later on, and
someone's
then it causes some trauma. Yeah, exactly. And so they made us put that out in the open right away. So I thought that was pretty cool. I was like, oh, that's awesome, because they said that's one of the number one reasons for divorce is finances. Mm-hmm. So that was pretty cool that they did that.
It's really good. Yeah. And I would say for me, I'm not married, but in the single world, it comes down to even like in dating, having conversations about credit, about finances and things like that. So I think overall, it's a big confidence booster in being able to know that you're good with your finances and you have good credit. And it helps you be better selective of your life partner, because when you select a life partner, you're selecting someone that you want to build life with. Yeah. And in order to be able to build life, you have to be able to be prepared with credit and making good money, being responsible and things like that. So I know it's not the only thing, but it's a big factor what plays into the role of finances. For sure.
Another one that I have written down, I think this one kind of tags along with saving money, which is investing. A lot of people want to start investing, and I think it's wise to start investing. Forever, I was always trying to figure out how to pay less taxes. Mm-hmm. Because I remember I read a book one time and it said, if you look, right, all of us, if you look, what is our number one expense? And a lot of people, you'll say your home or whatever, but when you really look, it's taxes. It's what we pay in taxes. So how can you reduce your taxes? And so you could go to CPA to CPA to CPA. I thought it was the CPA's job duty, right? To help me save taxes. No, it's your job duty. And now what I've done, what I've figured out from a lot of research, how can you pay less taxes is by investing. There's a lot of benefits aside of you getting a return on your investment. One of the other big benefits to investing on certain things, not everything, is one of the ways that you could save money on taxes is by investing. So, for example, like real estate. Real estate has so many different tax benefits if you invest in real estate. Solar, just different stuff. Different stuff has different benefits in the area of taxes when you invest in it. Mm-hmm. But anyways, as far as investing, yes, 100% I believe in investing. And one of the reasons why I believe also in investing, aside of it helping you out with tax benefits, is I remember someone told me this a long time ago, is if you just work, and you store your money away, that's lazy money is what they called it. It's lazy money. It's like sitting on the couch. Mm-hmm. If your money is in your bank, it's lazy money. It's not doing anything for you. It gaining 1% or whatever it gains at your local bank, under 1%, is not enough. Call that lazy money. You're the only one working. Vanica, Ricardo, we're the only ones working, right? You need more people working. And one of the ways that you get more people working for you is your money. You have to have your money working for you. So investing, I'm telling you, I jumped on that bandwagon a few years back, and like now I'm almost in the bandwagon that I've seen a lot of other people be in, and it's probably not a healthy whatchamacallit. I probably don't recommend it to everybody, but there's times where I'll invest everything that I have. because it's such a good investment. But definitely don't recommend that. I think you should always store some money away, have some money for emergency. But if I see a great investment and it means I'm depleting everything, I don't care. I'm going to do it. If I think it's a really, really good investment. And yes, it definitely, what people mention about investing, I've lived it. I've seen it. There's so many benefits. And, but anyways, one of the things to be able to invest is what? Is credit. Like, I would say one of the number one things that people want to invest in, there's several areas that you can invest. You can invest in stocks and bonds and stuff like that. But one of the most popular ones is real estate. Well, guess what? You need a good credit. And as a matter of fact, here's something that a lot of people don't know about. When you invest in real estate, you need even better credit than whenever you buy your primary house. A lot of people don't know that. Whenever you buy your primary house, you could get away with a 620 credit score or even lower. Whenever it's your primary house, whenever you're going to live in that house. But whenever you go to the bank and say, I want to buy that house, it's going to be an investment property. Okay, they're going to categorize that as an investment loan. An investment loan is higher risk to the bank. So because it's a higher risk to the bank, they are going to charge you a higher interest rate, right? But aside of that, to qualify for it, you need a higher interest rate than you would need if you were buying your primary house. So
you mean
yes,
higher credit score.
Higher credit score. Yeah, sorry about that. What did I say?
Interest rate.
Okay, yeah. You need a higher credit score. So yeah. So if you want to invest and you're at a 620, 630, and 6 whatever, somewhere around there, and you thought that you could still invest in real estate with that 620, 630 credit score because you could buy a house, your own house, with the 620, 630 credit score. No, the banks are a little bit more picky. Whenever you're going to invest in real estate, you will need a higher credit score. So yeah, so investing and in real estate, for example, you will need a good credit score. So, and I said earlier that investing kind of tags along with saving, because whenever you invest, you're getting a return on your investment, right? So with that extra money, it's, you can put it in savings or whatever you want to do, reinvest it and stuff like that. But yeah, investing is a big one that I always hear for New Year's goals. And so your credit has a big factor to investing.
And that consists of for viewers and listeners is that investing is like what they consider also like flip properties, right?
Yep.
When they're trying to also even flip, some individuals try to flip properties, and again it goes back to being prepared for the opportunity.
Yep. Flipping, buying and holding, whatever it might be, right? Like renting it out or just flipping, like you said. Yeah. You'll need, if you're going to borrow money from the bank for that project, yes, you will need a good credit score. You will need a better credit score than what you needed whenever you're buying your primary home. Yep. But what other? Because here in a little bit we're going to give everybody a couple of tips on how to improve their credit score. Because we've been talking about all these things,
all the benefits. What as far as how credit plays a role in these goals.
So we'll give everybody some tips on how to improve your credit score so you can achieve some of these goals. But any other New Year's resolution goals that we want to talk about?
I would say I think we kind of pretty much hit it on the marker if I do say so myself.
Yep. Car insurance, interest rates, security clearance, in other words, careers in the financial world, saving money, investing, buying a home, buying a car. Yep. I would say that's about all of them. So let's go ahead and give everybody some tips on how to improve their credit scores. So you want to start us off?
Okay. First, I would say starting off,
exactly what we tell our clients,
right?
right?
Yeah, exactly. You just make sure you're paying all your open active bills on time. You cannot fix your credit if you're not paying all your open active bills on time. And I'm not referring to anything that's already in collections. I'm talking about any open credit cards, any open loans that you have, whether they're personal loans, student loans. If you have even a mortgage loan that you've already had or a car loan, something that you have that you're paying on that's open and is reporting to your credit, you have to make sure you stop the bleeding.
Yep.
You know, you can't heal a wound if you don't stop the bleeding, or like what we tell our clients is like, it just doesn't make sense to start working or thinking your credit's going to be fixed if you're out trying to fix your credit. It's like washing your car in the rain if you're actively still paying those accounts late. So you got to make sure you pay on time. Be current.
And even if this, so I've come across two different scenarios. Like I had one the other day. One of my friends called me. He was mad at his credit card company, and he was about not to pay him. He was basically telling me, if I don't pay them, what could happen, right? Because he wanted to stop paying them. And he had like a 700 credit score. And I was like, no, I know you're mad at them. I've done the same thing, but keep paying it, because if you don't pay it, I'm telling you, you're not going to be the one. They're not going to be the one that's going to lose. You're going to lose. They're going to report you late. They're going to send you to collections. And then, yes, you might hire us, MSI Credit Solutions, to help you if that becomes a collection, but it's not guaranteed that we're going to be able to get that removed. And so I was like, if I was you, I would still pay it. And if there's something that you want to resolve with them, resolve it with them as you're paying it on time. You're not going to get anywhere. You think you're hurting them by not paying it? You're not hurting them. You're hurting yourself. And so, thank goodness he thanked me later. He calmed down and thought about it, and he took my advice. But yeah, if you have any negative account that you're paying late right now, for whatever reason, you're mad at the creditor. I don't know. Maybe you co-sign for someone and they're paying late. I would get that thing caught up regardless. I would get it caught up and then try to get the money from them. That's
a big thing that a lot of clients, when we speak to them, they think, well, I don't have to pay for it. They're the ones that are supposed to pay for it. I just co-signed, and like, it's your responsibility. That's a big part of being a co-signer, is being responsible. And that's been, I would say, when it comes down to clients taking a negative impact on their credit scores, a lot of times it comes down also to them co-signing.
Yep. That's a big one.
Co-signing.
Yep. So number one, everybody should look at your credit report and just make sure that you're paying all your active open bills on time.
And I'd like to add to that one as well, because a lot of clients can misunderstand. So open active bills, but also any accounts that were closed. So let's say your credit card, grantor, when your credit cards, they closed your credit card.
That's a good one right
so sometimes they'll close your credit card for inactivity. You haven't used it. Sometimes they've closed your credit card because you're maxed out on that card. But that doesn't mean it's in collections. That just means that they closed it from you being able to continue to excessively charge on that account, but you're still responsible to pay that debt back.
Yep.
And so if you don't make payments to that, it's going to report late every single month. So make sure you're paying those closed accounts that they closed your card. Make sure you're paying those on time as well, because that's not a collection account.
And great feedback, because more than ever, that's happening a lot right now. And why is it happening a lot right now? Because of inflation, holidays, right? These interest rates of 30%, 29%, 28%. Right now, I don't know the stats exactly, but I saw them the other day. We're like at an all-time high as far as the amount of credit card debt that consumers have. So get this. You mentioned earlier that they could close your credit card due to inactivity, right? Another reason, I don't know if you mentioned this or not, but another reason why they could close your credit card is if you use your credit card a lot, maybe these holidays. So the closer that you get to your limit, also the more debt that you add to your credit report, the lower your credit score becomes. So a credit card company, I don't know if you know this, but they're allowed to look at your credit report every single month. And if they see that your credit score drops, they will do one of three things, sometimes more than one of these three things. But they'll increase your interest rate, they'll close your credit card, and then increase your interest rate, close your credit card. I'm blanking out. What's the third one? Increase your interest rate. Oh, decrease your spending limit. Yeah, they'll decrease your spending limit. So anyways, but yes, so they will close your credit card. And back to what you were saying, if you use your credit card a lot this holiday season, and then all of a sudden your credit card company closed your credit card, some people think, like you said earlier, that now it's a collection. Oh, it's a collection. I don't need to pay it anymore. I'll pay it whenever I can. No. They just closed it because they didn't want you to use it anymore. So you are still required to pay it. You're still going to get a statement every single month, and you're still required to make the minimum payment or higher. And if you don't make the minimum payment or higher, they will report you late. And every time you get a late payment, your scores will go the opposite direction of where you're wanting them to go. So like you said, definitely 100%. If you have a closed credit card, that is still considered, in our eyes, an active open bill. You still need to pay that. Yep. So I'm glad that you mentioned that, because like I said, that's happening a lot right now. I know that a lot of people listening to this podcast, you probably have a credit card that your credit card company closed and you don't know why. And I'm telling you, it's because your scores decreased. You became a higher risk to them, and they're allowed to do the three things that I just mentioned. So yeah, thanks for mentioning that. So did you want to add something?
I would say also protect the card, like know how long the history of those cards, because sometimes a lot of clients, and I've even had this is a personal experience as well, where you have these credit cards and you fail to use them and you've had them for a long, long time. And they end up closing it because you didn't have any activity on there. Yeah. And therefore, it's like, wow, my scores just took a dip because that card just dropped. I didn't do anything negative. I didn't pay late. I didn't do anything at all other than just not use it. So in their eyes, they close it. And therefore, that does take a dip into your scores. Your scores would drop. So the recommendation that I would say is, if you have a credit card that you've had for a very long time, don't let it close due to inactivity. Have control over that. Have a subscription. It can be, some people have like their different types of like Netflix or their music, like Apple Music or Spotify, whatever the case is. Put one of those subscriptions on there and just set it up on auto payment and just let it do its job. Don't let it be a reason that your scores take a dive because you failed to use it.
Yep. And I learned the hard way too with that. They closed one of my credit cards.
Were you mad when it happened and you called them? Yeah, I was mad. Yeah. I was like, you need to open this back up.
Did they open yours back up?
No.
They never do.
Absolutely not.
All right. Here's so another tip. So make sure that you're paying all your active open bills on time. And B is look at your credit report and look to see if you have any derogatory marks. Derogatory marks are collections, whether they're paid or not. They're late payments, repos, foreclosures, judgments, tax liens, bankruptcies. If you have any of those negative items.
Even medical collections.
Yep.
A lot of consumers, a lot of our clients think that medical collections do not account for that, and they do.
And the number one reason I figured out why people think that medical collections don't affect you. Do you know why? You probably know why.
When they're going through the loan pre-approval process or approval process, they have is it called letter of an explanation? They get to explain kind of like what went on at that time. They're more lenient on those.
No, not exactly what I was looking for, but kind of. It's a good job, almost. So the reason why consumers get confused is because lenders say medicals don't affect you, but what they need to do, they need to go a little bit more in depth about what they're saying. They should say medical collections don't affect you in the home buying process. In other words, if your credit scores are where they need to be able to buy a house, it doesn't matter that you have these medicals on your credit report. They're not going to affect the home buying process. So a lot of people, when they hear that, they're thinking that a medical collection doesn't affect your credit score. Any kind of collection affects your credit score, including a medical collection. So yes, a medical collection does affect your credit score. But if you have over the credit score that your lender needs to qualify for a home, even though you have those medicals on there, yes, you could qualify for that home. But let's say your lender needs you to be at a 620 to buy a house, and you're at a 600, and you have 5 medical collections. Well, guess what? If those 5 medical collections weren't on your credit report, your score probably 100% would be higher than the 620, and now you would be able to qualify for a home. So yeah, they get confused when they hear lenders say, "Oh, medical collections don't affect you." Whenever you're buying a house, they need to go in a little bit more detail about that. So, but yeah, that was a good one. So, yes, B is look at your credit report. If you have any derogatory items on your credit report, do everything to resolve them. And what I mean by resolve them is do anything possible to get them removed from your credit report. So, a couple of ways that you could get items removed from your credit report is if you have collections, you could pay them. But you have to request a pay to delete. Mr. Collection Agency, if I pay this, will you remove it completely from my credit report? If they say yes, pay for it if you want, because it'll get removed from your credit report and your score will improve. But another way of trying to get negative items removed from your credit report is by disputing them. And that's what MSI Credit Solutions does. And there's a lot of other credit restoration companies out there that do the same thing as us. So if you want to go with someone else, no problem. If you want to give us the opportunity, we would love the opportunity. If you want to do it yourself, you could try to do it yourself. There's also a bunch of do-it-yourself programs out there. We have one ourselves. The website is, what is it? Do it yourself. Yeah, doityourselfcredit.com. So it's basically you could go in there. There's a small fee, And basically, there's a bunch of templates in there that you could utilize to send to the creditors and collection agencies to attempt to try to get those derogatory items from your credit report removed. But yes, so the two most common ways to get items removed from your credit report are paying them, as long as they agree to do the pay to delete, or disputing them. Those are two most common ways. There is also another common way, but I think this is a silly one. That's why I didn't even want to mention it, but that's waiting 7 years, right? Everybody's heard of that one. You could wait 7 years for the late payment to get removed from your credit report. You could wait 7 years for that collection that you have on your credit report to get removed. But living with bad credit for 7 years for it to get removed, that's a long time. It's way cheaper to go ahead and invest and hire someone or just do it yourself, on improving your credit score now versus 7 years. So did you want to add anything to attempt to remove negative items from your credit report?
I would say that you mentioned as far as the disputing and being able to the options of doing it themselves and hiring a company, whether it be us or whether it be anyone else. I would definitely say that it is important to make sure that you assess your ability to being able to do the legwork. If you do not have the ability and the time to do the legwork, then I strongly recommend to invest in a company to help you with that process, because life gets busy. Life gets busy. If it's a priority to you, you have to understand it's an investment. I think sometimes we get caught up in the mentality of, I'm just wasting money and spending money. And when it comes down to credit and financial goals, you can't see what you're putting out to fix your credit as wasting money. It's an investment. And in order for you to get something in return from it, you do have to put into it. And so taking advantage of a company that's going to do the legwork, I would, as far as like ourselves, and I would definitely have to say the way that we've stood ourselves apart from other companies is the education that we provide the clients, the systematic process that we have in being able to consistently work on the client's credit, being able to monitor and being able to continuously just keep the clients in the know through the process, but always actively working. We don't try to keep the clients in the program any longer than needed because they're a walking billboard. We know that clients have goals and they're looking to achieve, and time is of the essence for everything. So just like anything, if you have a time sensitive goal, you got to measure the steps. You got to kind of do the work a little bit.
And a tip that I will give also, I'm glad that you mentioned that because it gave me this idea. A tip that I will give to anybody that's thinking about possibly hiring someone to help them with their credit is credit repair is a service. A lot of people get confused. They think it's a product, right? The new iPhone came out. What's the newest one? 16, I think, right?
The 16.
So yeah, I mean, if you're buying a product, yes, shop it. See where you could find the iPhone 16 the cheapest, because whether you get it at, I don't know, at Best Buy compared to Walmart or whatever, wherever you get it the cheapest, it's going to be the same exact product. So yes, go for whoever will sell it to you for the cheapest. But don't go for the cheapest whenever you're shopping for a service. Credit repair is a service. What typically happens if you shop for the cheapest service? If you shop for the cheapest painter, if you shop for the cheapest landscaper, if you shop for the cheapest whatever, right? Car wash, what happens? You typically end up getting what you paid for. So credit repair is a service. Definitely don't compare us to another company just based on price, because it might end up hurting you in the long run. You might end up going that route. It might not end up working out. Why? Because someone might have been cheaper than, let's say, us, and then you come back to us, and now you invested what we charge you plus what you spent over there. So definitely don't go by the cheapest, because credit repair is a service, not a product. So that's a recommendation that I wanted to give out. So what's another area? So we said number one, pay all your active open bills on time. Number two, attempt to remove as many of the negative items that you have on your credit report. Number three, this is a big one for a lot of individuals.
I would say number three, and the experiences again, as far as going here, is a lot of individuals, when they're measuring and they're looking at their credit in situations like that, is making sure that you have open lines of credit, something that's actually reporting to your credit. And we've had individuals that start to think and say, like, the credit card is the devil. I'm going to pay that off, and I'm just going to cut it up, and I'm just going to close that thing. And again, it goes back to just what I said. Just as bad as it is for them to close that card for inactivity, just as bad as it is for you to cut that up and act as if it never existed and let it be closed. Or call to close it yourself. I hope I have an open line of credit. It's going to take time to build it, just like wine. It gets better with time. You got to let it age a little bit.
That's a good one. So definitely make sure that you have an open line of credit and that you're paying it on time, because a lot of people, they don't have anything open. Next one, debt. Debt is a big one. 30% of our credit score comes from debt. So a way to improve your credit score is eliminate debt. And kind of like you mentioned earlier, you touched up on it a little bit. So debt, a lot of us, that's another, I didn't even think about that. That's another big New Year's resolution for a lot of individuals, is they want to pay down debt. So a lot of individuals out there right now, you're going to pay off debt. So there is a certain type of debt, because you might not know, what debt should I pay off first? Should I pay off the one with the highest interest rate? Should I pay off my car first? Should I pay off my credit cards first? So what I would recommend is, what we recommend, not even I, what MSI recommends is pay off your credit cards first. And the reason why is credit cards, yes, they typically always have the higher interest rate. Credit cards right now have a 29, 30, right, 28, above 20% for sure. Vehicle loans, installment loans, right? You never hear really of an installment loan right now being 19, 20, 21% interest rate. So definitely you want to pay off your credit cards first, because A, they typically have the higher interest rate. But another reason why you want to pay off your credit cards first is they have the most negative impact on your credit scores. A lot of people don't know that. If you have $5,000 worth of auto debt and you have $5,000 worth of credit card debt, and let's say you have $5,000 from your tax return that you're about to get in February, if you put that $5,000 towards your credit card debt versus $5,000 towards that auto debt, your scores are going to increase more by paying off your $5,000 worth of credit card debt. So for sure, 100%, start off by paying off your credit card debt. It will help you out with saving money, because credit card debt has the higher interest rate. But number two, it's also going to help out your credit score more. So yes, paying down your debt is definitely going to improve your credit scores. So next one is what we tell all of our clients after 30% being debt is 15% your age of your credit. We touched up a little bit on it, but I guess we could go into it a little bit more in depth. Did you want to cover that?
It's just having that length of credit history, is being able, again, making sure that you can't expect to go open up that credit card today. If you don't have one, your credit scores are going to just instantly increase. No, you're going to see kind of a little bit of increase within the first 30 days. But in order to kind of see the average is about 4 to 5 months, about on average on an open line of credit. And the longer that they're open, then that's when it's going to start taking that higher impact, positive impact towards your scores and helping them maximize to their highest potential. And I would say being able to, depending on what kind of credit goal people have, if you don't have those that are open for quite some time and managing them correctly, I mean, I don't think I would have seen the 800s, so it's been a journey, it's a process, but it's just being intentional, and every single year having that goal towards making sure that you have that good history.
And the best tool to be able to increase your length of credit history is a credit card. A lot of people don't know that. And the reason why is, if you have an installment loan right now, let's say you have a car payment, but you have no credit card payment, you have no credit cards. So that car payment is going to be paid off in 5 years, maybe 6 years, right? I think they're doing car loans now for 6 years. I think maybe even longer, I don't know. But anyways, that car loan will eventually end. If you have a student loan, that student loan will eventually end. If you have a mortgage, that mortgage will eventually end. But how long can you have a credit card for?
Forever.
So a credit card is the best tool to age your credit. So definitely, if you don't have a credit card, definitely 100% have a credit card open and then leave it open. Don't ever close it. So
can I backtrack a little bit on the 30? So we just went over the 15% length of credit history, but going back to the 30% on amounts owed, another way to assist and help in that area is if your credit scores are increasing and your balances are extremely low, you also want to be able to take advantage of asking for credit limit increases, because that also helps your credit in a good way.
I'm glad you mentioned that. So what she's saying is 30% of our score comes from how much debt we have. And one of the things that they look at in the area of debt is they look at your balance to limit ratio. So the bigger that gap, the more it helps out your credit score. So yes, that's one of the things that you can do is you could call your credit card companies. You could ask them to increase your spending limit. And if they say yes, boom, automatically your scores are going to go up. As a matter of fact, it's funny. I went to a real estate seminar years ago. I mean, this was one of the first ones I ever went to. And that's one of the things that they did. I forgot what they did, how they said it or whatever. But anyways, they gave us that tip. you want to know how to improve your credit score right now on the next break? Grab your credit cards. We all grabbed them. Pull out your wallet, grab your credit cards. Okay, at break, call your credit card companies and ask them to increase your limit. And whenever you come back, we'll go over the further details. We came back. Raise your hand if anybody got their limit increased. And then he explained exactly what we just said right now. If you got your credit limit increased, now the difference between your balance and your credit limit has separated, has increased. So your credit score will increase, because the bureaus, that's one of the things that they look at. They look at, the difference. How much of your credit limit are you using? So your utilization ratio. So yeah, that's a good one. I'm glad that you mentioned that. So yeah, definitely do that. After you listen to this podcast, call your credit card companies and ask them to increase your spending limit. If they say yes, boom, within the next 30 days, your score will be higher. Yep. Yeah, thank you for mentioning that. So really the last one is inquiries. 10% of our score comes from inquiries. All we really tell our clients on this area is keep them to a minimal. Just keep them to the ones that you really need. You need a house, let the lender pull your credit. You need a car, let the credit union pull your credit. You need whatever you might need, right? You need to put your kid in school and you want to do a student loan and you're going to do it under your name, let them pull your credit. So, but if you don't need something in particular, I wouldn't let someone just pull your credit for a free T-shirt, for a discount at the mall register or something. Yep, the register. Yep. So yeah, keep inquiries to a minimal. Only the inquiries that you do need. So, anything else that you want to touch up on how to improve your credit score?
No, I think we pretty much hit it all on there. The other thing is just life gets busy, and I can't stress it enough. For one's personal usage and also for our clients, is life gets busy, set up those auto payments. Set up auto payments on, even if it's minimum, and going back and paying more. But the last thing you want to do is get a late payment just because life got busy on you, or whether it got hectic, whether something personal happened. You want to make sure that that's getting taken care of on the back end. Yeah. And also prioritize those goals that you have with improving your credit. What goals do you have? Again, most of our clients, I'd say over 90% of them want to buy a house. But then let's just say that that's not the only goal they want to tackle. Let's say they want to buy a car as well. And, some individuals want to buy that house and then they want to buy the furniture. It's all about prioritizing the order in that, because depending on the order that you do it, it can impact you even being able to get approved for the other things once you get approved. Yep. And so we've seen many of clients that had the goal of wanting to buy a house and they almost had that clear to close and being able to get the keys in hand, and that's got taken away from them for the sake that they went to go buy a new car to pull in that driveway to that new house that they're not going to get because again, you're adding more debt to credit. It impacts and decreases your credit scores. Then it puts you in a position where you're not even going to get approved for what the number one thing that you set that goal for, which is buying a house. And it's just all about just staying in the know, stay educated, and take advantage of using, services that can assist you. And as far as getting educated, we provide a free game plan here, for our clients. And I think that's what's the worst thing that you could do, or what's the least that you should do for yourself, is get educated, get a free game plan, let professionals take a look at your credit and give you the solutions and the options that you have. So that way, strategically, now you can break down those goals that you have, measure them, have that time sensitivity when you're trying to achieve them by, and actually make it happen. Don't let it just be a goal that you take in throughout the year or put it on your goal again next year. Yeah. Dive into it, be intentional about it, and make it happen. Yep. Good stuff. Amen. Amen. But yeah, really good stuff. I hope that you guys got a lot out of it, because, I hope that we were able to break it down for everybody here, because a lot of people don't realize how all these financial goals that you have for the new year, it all ties back to your credit. Mm-hmm. And improving your credit score is going to help you with all these different goals that we mentioned: buying a house, buying a car, saving money, investing, switching careers. It's all tied to your credit. A lot of people don't realize that. So anybody could benefit from this podcast. You could have a 400 credit score, you'll benefit from this. Mm-hmm. You could have a 600 credit score, you could benefit from this. You could have a 700 credit score and benefit from this. So I hope that you guys got something out of it. If there's anything in particular that maybe we missed or that you want to hear more about, please mention in the comments, and maybe we'll cover it on the next podcast that we have. But yeah, anything else that you want to cover with anybody? No, other than just have a happy new year and do everything that you can to make it the best. Yeah. And I would say, again, on personal experience, if you're not intentional, if you're not writing it down, if you're not revisiting those goals, then you're not measuring it, you're not tracking it, and it's out of sight, out of mind. Yeah. And I would say one of the most beautiful things that I have learned through my journey and experience, not only through life, but also here, is one thing that we've always dived into is like the vision boards. Yeah. I remember when I first started working here, Ricardo had like this vision board in his office, and I was like, "What is that?" He said, "That's a vision board," and it just had like everything that had his goals on there. Mm-hmm. And so I started doing that, and it's basically what is it called, the law of attraction, right? And so if you're seeing it, you're believing it, and if you're seeing it, you're believing it, and you're actually doing the work to get it to make it happen, and you're gonna just look back and say, you know what? Because I didn't allow it to be out of sight, out of mind, I've been intentional about this. Every single day we get up and we're going to work, and you're showing up in your career, whatever it is that you choose to do. And in those bad days, when you know what you're working towards and for, it just brightens up your day and it gives you purpose. And when you start achieving those things and accomplishing the things that you set yourself out to do and to achieve, it just changes your perspective. It changes your appreciation. It makes you be grateful for the things in life. And then the wisdom that you learned through the experiences that you've gone through and the work that you did, you get to teach someone. And that's the beautiful thing, to being able to sit here, to being able to create these podcasts, to be able to educate our clients, and most importantly, your family. It's a beautiful thing when you can help your family and your loved ones. So I hope that everyone can take something positive from this today.
And stay with it too. Don't be like the other New Year resolution goal that everybody has, right? Health. Like the gym was packed this morning. Boy, it was packed. I mean, we all know that, right? It's always packed. But it's funny, right? People always joke like, give it a week and it'll be dead again, right?
Yeah.
But yeah, don't give up on your goals, because kind of like you mentioned earlier, definitely if you improve your credit score, I mean, it's just ongoing. It's ongoing. The toughest part is getting started. I would say the very beginning is the toughest part. Improving your scores, and then paying off this debt, whatever, accomplishing this goal. But then they'll just start snowballing. And it just gets easier and easier and easier. So stick with it. And like we said earlier, hopefully you got something out of it. And if there's anything in particular that you want us to create a podcast from, please comment below, and we'll make sure that we do that. So
thank you for watching MSI Wealth Chronicles, building legacies one episode at a time.
Thank you very much for listening.
Have a great one.